Welcome to Bloomberg ETF IQ. I'm Scarlett Fu.
And I'm Katie Greifeld. Happy Monday, Scarlett Fu. Dip buyers, MIA right now.
Well, they weren't there on Friday either.
That's true, in a big way. Let's get to the biggest stories right now in the more than $15 trillion global ETF industry. Investors greeted this Monday with a little bit of volatility. Some tech stocks remained under pressure ahead of NVIDIA earnings. Actually, a big wipeout in the NASDAQ 100, Scarlett.
And this hour, we speak with ETF pioneer Bruce Bond. He's CEO and co-founder of Innovator ETFs. He is one of the most influential voices in the industry.
Meanwhile, European ETFs on a tear to start the year, with the main fund easily outpacing the U.S., but investors just not buying into it. All of that and more coming up, but let's get over to Eric Balchunas from Bloomberg Intelligence, here with us now, looking at the flows. Eric, what do you got?
Katie, Scarlett, thank you. Yeah, no European ETFs. That is interesting. Nice run for Europe, but nobody biting just yet. But what we do have is a lot of the U.S. equity ETFs seeing inflows. That's a monster amount of money for SPY. $8.5 billion. That's the trading crowd. That's a good sign. So ETF investors still buying in strong. $30 billion for the week, by the way. Now $165 billion for the year. That's on pace to take in $1.3 trillion this year. So we're at record pace after last year. Amazing. GLD, this is a really shocking number here. I'm going to go more into this in a minute. Gold's been at all-time highs. Nobody's really bitten into it until this week. Qs, again, that's bullish, and VU. So you got a lot of equity here, a little gold, though, there's some treasuries. So a little hedging, but not much. Let's look at the outflows, and you'll see there's barely any. Look how small these numbers are versus the inflows, nothing in the billions. So maybe a little bit of risk being taken off here from semis, but this is really nothing to write home about. That plus 30 billion is what we're really looking at here. So let's look at gold this year. And we've been writing about this because gold is at all-time highs, having a great year. Normally, you'd see a bunch of people pile into gold, but it hasn't happened. This is a chart showing the cumulative flow into gold ETFs. It's been negative, actually, for a while until September last year. Now it's slightly positive. This was before the 3 billion, this chart. So you probably have it up here after the GLD flow today, but still nowhere near Bitcoin ETFs. So our thesis is that the Bitcoin ETFs have come out and they've stolen a lot of gold's thunder for that store of value flows, because Bitcoin's been up like triple gold and just basically taken a lot of those flows, Katie. So, but maybe, you know, this is gold's finally getting some nibbles.
Yeah, it's interesting. It feels like there's several dynamics at play here, Scarlett, where similar to gold ETFs, not really seeing a lot of love until this point. European ETFs not really breaking in the big bucks, even though the performance has been there. Meanwhile, U.S. equity ETFs still seeing a lot of money.
Everyone's still convinced the U.S. is the place to be when it comes down to it. Let's bring in now our first guest, Rachel Aguirre. She is head of U.S. iShares product over at BlackRock. And on the heels of what Katie was just talking about, the American exceptionalism trade seems to be fading a little bit in 2025. How big a week is this for the resetting of expectations for the Mag 7 American exceptionalism thesis? We have reports of Microsoft canceling data center leases. We know NVIDIA will be reporting results, and certainly it'll be impressive growth rates, but expectations are pretty sky high.
Well, thank you so much for having me. It's so great to be with you today. I think, you know, it's important that we take a step back and really think about what's going on in the U.S. equity market. It's over the past several years undergone a massive reshaping. Yes, AI is dominating the conversation today in so many different ways, but larger picture here is that we're seeing record levels of market concentration, and the impact of mega cap securities on the U.S. equity markets are larger than they ever have been. If you look at the S&P 500, the top 20 U.S. companies, the largest companies, now represent 45% of the overall U.S. market, and they've contributed more than 2/3 of the returns of the last 3 years. So yes, that's tech. Yes, that's Mag 7. Yes, that's AI. But I think it's really important that investors take a step back and think about how they're investing across the large cap, market cap spectrum. What we've noticed is that many investors haven't captured that growth. And if you look at the average advisor portfolio right now, they're meaningfully underweight mega caps. So yes, it's incredibly important that investors are looking at just how they're intentionally targeting their market cap exposure today.
Well, speaking of AI, you recently launched the iShares AI Innovation and Tech Active ETF. I believe that's your fastest growing active equity ETF, just about 4 months old. And I'm actually going to cite some of Eric's research here, because you take a look at the fund landscape in January, I believe 93% of the new launches were actively managed. So we've been talking about this active trend for a long time, and it continues to just build momentum. Talk to us a bit about where BlackRock sees the white space still left in active and what your ambitions are there as a firm.
Well, you know, the pace of innovation, just broadly speaking, has been mind-blowing. In 2024, we saw a record number of new products hit the market, with over 740 new products. Over 3/4 of that were actively managed ETFs, alpha-seeking strategies, outcome-oriented ETFs, all of the things that we've been talking about here. And so what we see is just a need for incredible amounts of investor education in this space, and for innovation to really kind of stand out versus the noise. So we believe AI is an area that's really in focus right now, but importantly is an area that investors need to think about how they're getting exposure to. That is why we launched BAI. It is our largest, our fastest growing rather, AI-focused active ETF. We launched it so that investors would have a way to target those AI names as clients we see, more broadly speaking, rethinking their tech exposure.
Yeah, certainly one of the tickers to watch as we await an NVIDIA earnings coming on Wednesday. But I want to talk a little bit about the innovation that we're seeing in the ETF wrapper, because also from Eric's research, of those ETFs that launched in January, 74 products in total, 61 of them use derivatives. And we've definitely seen this boom in derivative ETFs. And I'm wondering if there's anything that BlackRock wouldn't do. For example, we've seen an explosion in leveraged single stock ETFs, certainly have seen a lot of uptick and uptake from retail investors. Is that a space that you would consider exploring?
Well, let me just say this. Our innovation is grounded in 3 primary principles, and it really is apparent and present in any type of innovation that we pursue. The first is it needs to be an exposure that our clients are seeking, that they're looking for, that it's solving a client need, a tangible client need. The second is that there has to be this strong investment thesis that is behind it. And then third, it needs to be a strategy that is suitable for the ETF wrapper, for daily transparency, for the needs of liquidity. And so all of those 3 components are incredibly important and are how we think about bringing new innovation into the market.
So Rachel, is that a no? Just to tie a bow on that.
Look, I mean, as it pertains to leverage specifically, we believe that the usage of leverage can solve for a wider range of client needs, but how it's done is really important. If you look at a product like 2X, that was a product we launched in January of this year, the iShares US Large Cap Accelerated ETF. That's an outcome-oriented ETF that is targeting 2 times upside participation in the S&P 500 up to a return cap. At the same time, 1 times downside participation over a calendar quarter. That's fundamentally different than traditional leveraged ETFs that reset on a daily basis that are typically used on a tactical basis by day traders. So they're 2 entirely different things. We do see the use of leverage as a way to solve client needs and a wider range of those client needs.
Yeah, so I actually lump the leverage ETFs in a larger pool, even with crypto ETFs, and even BAI, your tech ETFs, is 38 holdings, very volatile. So I call that all hot sauce. You're just making the milder forms of it. But I want to talk about the crypto area because to me, IBIT and ETHA are definitely volatile. Those are used as like a small portion on a portfolio. Do you have any plans to go into Solana? Because we just saw Franklin Templeton as the first sort of legacy big dog active manager that has filed for a Solana ETF. And I was thinking maybe BlackRock might be interested as well.
Well, I'm going to go back to our 3 principles because we continue to be focused on those 3 components. Number 1, what is the client need that, a given product is meeting. Number two, what is that investment thesis? In the world of cryptocurrencies, not all currencies are the same. That investment thesis is imperative. And number three, is it something that is suitable for an ETF wrapper? Is there sufficient liquidity? Can it support transparency, et cetera? So our principles remain the same, whether that be an actively managed strategy, whether that be a strategy that employs options and other derivatives, or whether that be a strategy in the space of cryptocurrency.
All right, Rachel, really appreciate you taking some time with us on this Monday. That is Rachel Aguirre of BlackRock. Now, coming up, as we were talking about, European stocks are on a tear, but U.S. investors not interested. We'll discuss next. This is ETF IQ on Bloomberg. Welcome back to Bloomberg ETF IQ. I'm Katie Greifeld. It's time now for the ETF Brief, where I walk you through the trends and the stories that caught my eye in the ETF industry. And we start with gold. As Eric was mentioning, gold has posted 8 consecutive weeks of gains, hovering near an all-time high. We've seen holdings in bullion-backed ETFs soar to the highest level since January 2024. You can see it in orange there, not quite gold. What's interesting is that GLD, it's the biggest gold ETF. It saw its biggest one-day inflow ever in its history on Friday. So investors really waking up to the gains that we're seeing in gold. Let's also talk about an interesting category of ETF that has come about. These are private asset-like ETFs. As we know, the SEC has not yet allowed private assets to actually be in the ETF wrapper yet, but you've seen some intrepid issuers try to launch ETFs that would mimic the returns and the holdings of a private equity portfolio, a real case of know what you own. So we'll continue to track that. But let's talk about Europe. We've been talking about this outperformance that we're seeing by European equities. But if you take a look at the flow picture here, you've seen some inflows in February, but not a huge amount of demand, not necessarily trying to chase that performance, Scarlett.
All right, so Eric, you are our go-to guy for all things ETF and flows. Is this because there aren't as many European equity-focused ETFs listed in the U.S.?
No, there's plenty. There's Vanguard, iShares. They have like a ton of European ETFs. It's because people have seen this movie before. It's more like a short film, to be honest.
Oh, God.
Europe has like 2 months where it like beats the U.S., and then like a freight train, the queues just runs it over. And that's happened about 10 times.
So it's like the small cap story, too.
The same thing, small cap story. This, outside of U.S. large caps, that's why people keep feeding money into the U.S. large cap space. I also think narratively, people just think Europe doesn't have growth or tech. And so I think you need the U.S. tech and growth story to like be damaged first. Then they look around and Europe might look cheap. That's my thesis. Or you need Europe to outperform for 6 or to 10 months, not 2, before people are like, okay, it's legit this time. Otherwise, it's just like Lucy pulling away the football.
Yeah, I mean, we were talking about it with Gina Martin Adams on Wednesday, and I used the phrase false dawn, and that's what it feels like. I mean, Lucy pulling away the football, maybe that's more of an image. But
False dawn is way more poetic, though, and I like that. I might steal it.
I'm going to write about it in my diary.
So as bullish as people are on European defense companies, it's not enough for them to keep pouring money into that sector or into the region overall, apparently. Okay. Thanks very much for on that. We are going to stay focused on innovative ETFs because still ahead, we're going to drill down into buffer ETFs with Bruce Braun. He is CEO and co-founder of Innovator ETFs, but that doesn't do his contributions justice. This is Bloomberg. This is Bloomberg ETF IQ. I'm Scarlett Fu, along with Katie Greifeld.
And it's time for today's drill down, where we focus on one ETF. Eric, what do you got?
Katie, today we're looking at what we call a buffer ETF. If you watch the show, you've heard us refer to buffer ETFs, and let's go over what that is. This is a whole new category that was invented, 5-6 years ago. This is the Innovator Defined Wealth Shield ETF. BALT is the ticker, and if it reads right here, it gives you a downside protection of up to 15 to 20% of losses. So if you're looking to protect money, you think the market's just really long in the tooth, this is a way to ensure that you don't have to stomach all those losses. Some give you 100%. So there's all different styles and flavors of these buffer ETFs. This one's 15 to 20%, and it resets every quarter. That does make this one unique. And you see here it's got 1.18 billion, so that's a big buffer ETF, one of the biggest. It came out a couple of years ago. Let's look at what it holds. So the way these buffer ETFs work, they're just very creative using options. An institution would do this all day long in the past, but a lot of what ETFs done is they package up what institutions used to do and make it available for everybody. So that's really all that's going on here. And you can see these are some SPY options to create that targeted outcome. Let's look at the performance of this versus SPY. And I also threw in the aggregate bond ETF because I really think buffer ETFs are competing with bonds almost more so because bonds have been awful. They don't even keep up with inflation. They didn't do anything in 2022 to protect you. So BALT is up 23% in those since it came out. Now, it's only half of the market, but look at bonds. So you can see here, if somebody's looking to protect their portfolio, you can see why they might go here instead of here. And in 2022, when the market was down, you see the market going down here? Well, this is the buffer ETF here. So it was actually up 2% that year. And so, Katie, with a lot of older investors nervous about the market being, in bull market territory for so long, you can see the appeal of these ETFs.
Boomer candy. I think that's the phrase that you coined. Eric, thank you. Joining us to talk about this ETF, I am thrilled to say we have Bruce Bond. He is co-founder and CEO over at Innovator ETFs, joining us in person. Bruce, it is great to see you.
Yeah, thank you for having me. It's great to be here.
I have a ton of questions for you, not
Okay.
just related to this specific ETF, but let's start there with BALT, because my understanding, as Eric just walked through, so it protects you 15 to 20% of downside in approximately a quarter. The upside cap in that quarter is 2%. So talk me through this. I feel like you'd have to be pretty bearish to want to hold a product like this.
I think the idea here is, BALT, first of all, is for bond alternative. So, think about this way. You're trying to have a conservative exposure to the market. What do you use? You use bonds. But BALT actually has much lower volatility than bonds have, if you think about all the volatility in bonds lately. So now you can have exposure to the S&P 500. You have a 20% buffer on the downside. So the market can go down 20, you don't lose anything. Now that's just in a quarter, but you get 2.5% on the upside. So if the market's up, you get 2.5%. If the market's down, you're probably not going to lose. Very rarely has the market been down more than 20% over a quarter. And so it's up potentially 10% over the year, and you have these 20% protections or exposures over the quarters. And so people are saying, why not tie my safe money to the equity market instead of tying it to the bond market? That's really where this is coming from. To give people an alternative to just bonds as safe money.
So the ETF was launched in summer of 2021. Is there a seasonal pattern here to inflows into BALT? All this talk right now about how the U.S. stock market is entering a seasonally weak period for it. Do you tend to see more money coming into BALT as a result?
Not really. I mean, BALT now is kind of a mainstay for a lot of people. If you think about how people use bonds and equities, kind of they're non-correlated with one another. So if you take half of your bond exposure, for example, and put it into BALT and you keep half in bonds, well, now you create a low correlated safe asset in your portfolio. And that's what a lot of people are doing with BALT.
And we've seen you're an innovator, hence the name of your company. You created PowerShares. You kind of, I think, kicked off Smart Beta. Then you came out of nowhere and created this new white space. But you have some serious competition now coming in, which I think you should take as a compliment. But you've got First Trust, who actually has a little more market share a little bit, but you guys kind of dominate. Then you've got BlackRock, Fidelity. These are some big names coming in. How do you fend them off? Is it good for the space? How do you feel about that?
I think it's good for the space. I think even back when we started doing some of the initial quantitative type indexes, which were the precursor to Smart Beta, I mean, the market exploded. And you're seeing that happen here. When you bring an idea like this to the market and people realize it as a good idea, there's going to be follow-on. It's very difficult to patent something like this or protect yourself in the market, so you tend to see this. And so I think by and large, people are maybe moving away from some of the Smart Beta or some of the transactional or trading type structures into what we call defined outcome. These are defined outcome because you can know what your potential outcome is just by knowing, I'm protected this much and I have this much upside. That gives people a known outcome rather than just hoping for the best in the market.
Something that I wonder about, because now we've seen, as competition has intensified, all these different flavors of buffer ETFs, including max downside ETFs that say that they're going to shield you against 100% of losses. But I wonder what happens to those products mathematically. Do they still function when you have rates that actually move down? It feels like a market environment that's far away with all these concerns about inflation. But once the Fed starts aggressively cutting interest rates, what happens to those funds?
Well, if rates go low, you're going to see the cap move way down as the rates get lower. So it will have an impact on the potential outcome of the products. And at Innovator, we have a 6-month product, a 1-month product, and a 2-year product. So what we expect to happen is if the cap isn't good enough for people in the 6-month product, they may rotate to the 1-year product or the 2-year product to get a little more cap, and but to still stay involved. Because one thing about those 100% buffer products, I mean, you can't lose in the product.
Yeah.
For example, JAJL, the one that we have, it's 6 months. You get 3.75% upside, over 6 months. Plus, you have no risk of loss if you buy at the initial offering. So people are just really excited about it. I mean, you can buy that in an ETF. I mean, can you imagine? I mean, you couldn't touch that type of thing before Innovator started bringing these products. And so it's pretty exciting.
You came out with some Bitcoin buffers, and Calamos did as well. Yours is the Bitcoin 20 floor. I think they have a complete downside hedge. When these came out, a lot of people were like, you don't want to buffer with Bitcoin, because why would you want to limit those melt-ups that Bitcoin has? What do you say?
That's a great point. We also had a hedged Tesla at one time, and we didn't get any money. Nobody wanted that, because they want exposure to Tesla, So, but in Bitcoin, what we did, because of that experience, we said, look, we're going to give you exposure to Bitcoin, but you're only going to get 80% of the exposure. So if Bitcoin runs up 100%, you're going to get 80%, 70, 80% of the upside, and you have a 20 floor. Now, the 20 floor is you can lose 20%, but you can't lose any more after that. And so people are like, okay, I want to be in Bitcoin. How do I participate? But I do want to get the big pop when it happens. This allows them, it's a participation rate rather than a cap.
Right.
So that if you have a huge run, they get to participate all the way up with that. Maybe not 1-to-1, but they get to run up with it. And then they still have the floor in there in case things fell apart.
Bruce, unfortunately, we're up against the clock. Have to have you back soon. I feel like we're just getting started. That is Bruce Bond. He is the CEO and co-founder of Innovator ETFs. And you can read all about this drill down, plus the latest in the ETF industry, when you subscribe to my weekly newsletter on ETF IQ. That is Bloomberg.com/ETF IQ newsletter. That does it for Bloomberg ETF IQ, the television show, though. I'm Katie Greifeld, along with Scarlett Fu and Eric Balchunas, and this is Bloomberg.